Pros and cons of setting up a family trust in Canada. The potential benefits of a family trust. 1. Reducing your tax burden. Once the assets have been transferred to the trust, they and the income they generate are no longer part of the settler's patrimony and can be allocated to the beneficiaries, who must include them in their own tax returns. This results in income splitting. Because Canada's tax system is progressive, this can help reduce the overall tax burden. For example, two people who each report $50,000 in income may owe less tax overall than one person who reports $100,000. However, there are a number of tax laws that restrict income splitting. If you want to create a family trust solely for the tax advantages, it's important to weigh whether it's worth your while. Speak with a tax specialist for more information. 2. Reducing taxes payable at death. The estate freeze strategy. Owners of incorporated businesses can use a family trust to reduce the tax payable upon their death. Here's how it works. The trust becomes the owner of participating shares in the corporation at the time of the freeze. Any increase in the value of the shares will occur within the trust, which means that it will not be taxable at the business owner's death. Tax will need to be paid when there is an actual disposition of the new shares held by the trust, example, a sale, or a deemed disposition, i.e., a notional sale to assess how much tax is payable. In the case of an estate freeze, a family trust also allows a great deal of flexibility in determining who will take over the business and how. Probate in common law provinces. In the common law provinces, estates are required to pay probate fees, which are a form of estate administration tax. When property is transferred to a family trust, inter vivos, it is no longer subject to probate with the deceased's estate. Depending on the deceased's province of residence, the savings may be substantial. 3. Planning for the transfer of your wealth. Family trusts can be used to pass on wealth within the family. They allow you to specify who should receive the money and what it should be used for, whether during the settler's lifetime or after their death. One advantage of using a trust is that it can prevent children from frittering away their inheritances. It's recommended for high net worth individuals to plan for the transfer of wealth as part of estate planning, which may involve a family trust. 4. Protecting your assets. A family trust holds property on behalf of the beneficiaries and protects it from creditors. The trust assets cannot be seized following a lawsuit or personal bankruptcy. It's important to remember, however, that the trust must be created when everything is going well. If trouble was already brewing when it was set up, a judge may still allow the assets to be seized. 5. Protecting a child. A family trust makes it possible to give someone a gift without simply handing it over to them. For example, a trust could be used to secure the future of a child with a disability or to provide for grandchildren. The rules established when the trust is created can include provisions on how children should receive the money. The disadvantages of a family trust. The 21-year rule. The main downside is the 21-year deemed disposition rule. Under the Income Tax Act, trusts are generally deemed to dispose of their property 21 years after their creation. The trust is considered to have sold all its assets at once, and all the unrealized gains on the trust property are taxed. So, while trusts can remain in effect for a long time, they can't last forever. It's up to the settler to decide when the trust should be wound up. All trusts should include an ultimate distribution clause that sets out when and how the trust assets will be distributed. Significant administrative requirements. The income tax rate for family trusts is the highest marginal rate. Trusts are taxed on the income they generate and must file a T3 return, linked to external site, every year and issue tax slips. Furthermore, under new rules, most trusts are required to file a T3 return even if they have no tax to pay or income to report. Record keeping. The law does not impose any specific record-keeping requirements on trustees. However, trustees have a duty to document their work so that they can account for their administration of the trust and the tasks performed. The way that they document it may vary depending on the type and value of the property they are responsible for. Trustees must also take minutes of their decisions and produce financial statements. Is it better to have a will or a trust in Canada? A will is a legal document that communicates how you would like your assets, property, and estate distributed upon death. It can also communicate who will manage the estate until distribution. In many ways, a will and a trust are similar, so which is better? Generally speaking, a will can be more easily challenged in a court of law as opposed to a trust. In addition, trusts avoid the probate process, which can reduce tax burdens and the time for people to receive their inheritance. If these are things that are concerning to you, the use of a trust can provide advantages over a will. However, it is still recommended you have a will for assets held by you personally. But on the other hand, trusts require more administration than a will. This means trusts are more expensive to maintain. Some may prefer to keep things simple and not be concerned with what happens after they die, thereby preferring a will. At the end of the day, it all depends on your financial objectives and goals. Be sure to consider those when deciding whether a trust, will or both is ideal for your estate plans. How to create a family trust. Are you thinking about setting up a family trust? Start by asking yourself these questions. What objectives do you hope to achieve by creating a family trust? Who will the settlor, the trustees, and the beneficiaries be? What property will be transferred to the trust? Which trusted experts can assist you with the process? Next, follow the key steps in creating a trust. 1. Draw up the trust agreement. The trust agreement, or trust deed, names the trust and determines its intention or objective. It also specifies the trustees and beneficiaries and can include various clauses. Ideally, this step should be handled by a notary or a tax lawyer. 2. Make an initial gift. To create a trust, the settlor usually makes an irrevocable gift. To avoid the attribution rules when setting up a family trust, the initial property transferred to the trustee could be something like a silver coin or bar. 3. Open accounts for the family trust. You may need to open one or more bank accounts for your trust. Ask for help with this step from a financial planning specialist at your financial institution. 4. Fund the trust. Your tax advisor can provide a list of steps for transferring assets to the trust. These assets may include real property, vehicles, works of art, collectibles and heirlooms, bank accounts, company shares and other investments. 5. Register the trust. In certain cases, trusts must be registered with your province. A notary, lawyer, or tax specialist will be able to advise you on whether this is required in your case. There are fees associated with the various steps in creating a family trust. How much does a family trust cost? The overall cost is highly variable. To avoid surprises, be sure to factor in the fees charged by the various professionals involved in the process. A family trust is a sophisticated tool with a multitude of associated legal and tax rules. Don't hesitate to ask our experts for help analyzing your situation and setting up your trust. They can also advise you on how to optimize it and make the most of the many benefits it offers.